name is Bret Jensen of the Biotech Forum. Today we're going to go ahead and recap biotech sector performance in 2017 and spend some time on talking about what things are in store for 2018, especially in regards to merger and acquisition activity. And we're going to go ahead and call out a half dozen stocks that are potential buyout targets in the new year. Biotech sector had a fair year this year. The overall market was up about 20% on the S&P 500, while at all-time highs across the major indexes, and the tax reform bill just got passed. We're speaking to you on Wednesday, December 20th. Biotech sector performed largely in line with the S&P after two down years or underperforming years in 2015, 2016. Which was very solid performance given we had a complete dearth of M&A activity throughout 2017. Came in about half the level of the boom years of 2014, 2015, and there were reasons for that. That should go ahead and dissipate in the next year. One of the biggest factors keeping deal volume down this year were the unknowns from what the tax structure would look like in 2018. There were a lot of doubts what, if any, reform was going to pass, and you had a lot of drug and pharma giants sitting on their hands waiting for this clarity. That clarity has now been provided, and looking into 2018, we should expect a market uptick in M&A activity in the new year. Simply put, the pharma and the biotech giants have hundreds of billions of dollars that are stashed in the overseas operations. Now that the repatriation taxes have been worked out, I would expect a lot of that money to come home to the U.S. Some will be worked into R&D, some will go to stock buyouts, some might go to dividend increases, but a lot of it is going to go to acquisitions. And one of the main reasons that's going to go ahead and happen is that most of the major drug firms are having a very challenging time doing any kind of organic growth these days. Most of the growth is coming from price increases, which is more and more of a challenge in this environment. And we have a very supportive regulatory environment. There's two types of firms we're going to go ahead and talk to today as far as potential drug and bio targets. First of all, we're going to talk about rare disease firms. Now, rare disease is a great area for acquisitions because populations are known, usually very small. They can be serviced by a small sales force, and you can quickly ramp up your sales because of this. You're not competing in mass market. In addition, there are very few competitors. By the nature, rare diseases are not targeted by multiple firms. In addition, with new leadership of the FDA, the process and costs to get through the development process and get a rare disease compound approved is becoming simpler and less costly. They're erring on the side of getting products to market to treat untreatable or previously untreatable populations. We're also going to go ahead and talk about small concerns that have recently had newly approved compounds. They are going between the what I call Tier 4 development firms to Tier 3 marketing entities, and that's always a challenge. And usually when you get to this point, there's a lot of pressure from shareholders and also management that rather spend their time on development rather than commercialization processes to go ahead and sell out to a larger suitor. In addition, these tend to be very easy sales ramp-ups as well because usually the buyer has a large sales force and is simply putting one more bottle in the truck, if you want to think of it from a liquor distribution model. And it provides a nice, quick, and easy pickup to earnings and revenues at larger firms, which they desperately need right now. And with the new tax reform package, those profits are going to be taxed at 30 or 21% rather than 35% previously. So we're going to take a look at a half dozen potential buyout targets. The first one is a company called Sarepta Therapeutics, or SRPT, on the NASDAQ. Sarepta has a $3.5 billion market capitalization, approximately. They have one currently approved drug that got approved in the second quarter of this year. It's aimed at a very, very rare disease called Duchenne muscular dystrophy. Affects mainly teenage boys. There's only a few thousand population in the U.S. affected on a yearly basis, but sales have already ramped up quite spectacularly. $46 million in the third quarter, which was about $15 million above expectations. The company revised guidance to about 155 million in sales this year, and that'll wrap up quickly coming into the next year. That one drug is the main asset. They do have one other late stage drug aimed at the exact same disease area, and that should probably be approved sometime in 2018, 2019. And between the two drugs, you're talking about a $1 billion peak sales potential. Right now, the company sells for about $55 a share. The consensus price target is about 75, which makes sense in a buyout scenario, or if they continue to ramp sales. There are numerous potential suitors. Shire, which bought Baxalta a few years ago for $30 billion, is one. Alexion Pharmaceuticals would be another. They have new management, and they're either going to probably put themselves on sales, or they're going to go ahead and make some small purchases, and Sarepta would make a perfect fit for them. And there's also BioMarin Pharmaceuticals, another rare disease concern, much larger. And there's French drug maker Sanofi, who's been rumored at one time and has been a bridesmaid too many times for their shareholders' perspective. Then going to have to make a move sometime in 2018. Our next potential buyout victim is the aforementioned BioMarin Pharmaceuticals. This is about a $16 billion market cap company. It has 6 different approved products on the market. Sales in 2016 were about 1.1 billion. Should come in about 1.3 billion this year, and 1.5 billion in 2018. They also have a late-stage hemophilia A drug candidate that has a lot of potential. It sells for about $90 right now. Consensus price target is about 125, which would be a good premium buyout. It's a reasonable value right now. You're probably talking more like 110, 115 if we do get M&A in the space. It's a low risk play. Next up, we're going to talk about 4 smaller companies that I believe can fetch much higher buyout premiums, starting with a company called Synergy Pharmaceuticals, SGYP on the NASDAQ, about a $500 million market cap company. They have been terribly mismanaged by their leadership team. The stock sold as high as $7 in January, where their first drug product, Trulance, was approved for chronic idiopathic constipation, and now sells at $2 a share because they had a little bit of hubris. They sort of showed out for about $8 to $10 when they had the chance earlier in the year. They've mismanaged their financing and their communication with shareholders, but now makes a huge bargain where it sells at about $2.25 a share, $2.25 a share. In fact, this week, the CEO announced he was stepping down, and shareholders applauded with about a 20% rally in the stock. The stock is still undervalued because Trulance is going to be approved for IBS-C on January 24th. That'll expand their market by about a third. Peak sales potential is about 500 million, which is ridiculously low for this current market cap. I also think this could easily attract several players as far as want to expand their GI focus area. and quite possibly even a hostile buyout from combination of activists and possibly a PE firm. Shareholders are hoping to get $8 or $10 earlier in the year. Would probably be more than happy with $4.50 or $5. I would look for this to be very active in the first half of 2018. Our next company is even smaller. It's a company called Neos Therapeutics, NEOS on the NASDAQ. About a $280 million market cap. This is the opposite of Synergy. They actually have wonderful management. They've had 3 recently approved drugs. They've got through approval with hardly a hiccup. They target ADHD, or attention deficit disorder, which has quietly become a $10 billion market just in the US alone. There's a lot of different players in that. They have a real nice niche. The 3 drugs, probably talking about $400 million in peak sales in the right hands. They're selling for about $10 a share. The consensus is around 20. I think they could easily be bought out in the first half of 2018 in the mid-teens. They've already rejected one buyout offer last month from PDL Biopharma for $10.25. The stock was selling about $7 at the time, as being much too low, undervaluing the company, and I actually agree. Next up, we're going to get a little larger, a company called Adamas Pharmaceuticals, or ADMS, about $750 million market cap. They just recently had a drug approved for some symptoms of Parkinson's. They're the only ones that are in that area right now. They also have a couple other drug candidates in development for both Parkinson's and MS, and for epilepsy that have promise. Now this one is already doubled on approval because their primary drug product that has been approved, called GoCovery, actually came out with a list price about twice what analysts were expecting, because the demand in the market is very strong for this treatment. The stock is currently selling at about $32 a share. The median price target on it is $52 a share. But recently, Evercore ISI has put an $85 a share price target on the stock because they see significant upside, because they think the drug will rapidly receive market share in their space. You also have some notable hedge funds that have taken big stakes in the firm, including Stevie Cohen's 0.72, which has an over 5% stake in it. There was also another investment manager up to 7%, so this stock could easily be in play. There's various larger firms that could go ahead and make a play for this one. I personally think Biogen is probably the most logical acquisition suitor, simply because earlier this year they went ahead and spun off their hemophilia business for about $5 to $7 billion through a spinoff. And they have said they want to go ahead and expand into the central nervous system area and increase their footprint there. Finally, our last stock is our largest stock, other than BioMarin, that I think is a potential buyout target. I will go ahead and put a caveat on this, that I don't think this one is likely to get into serious negotiations around price until the second half of the year. And there's a couple of reasons for this. Number one, Baker Brothers owns about 22% of the firm. I think they're going to want to see a uptick in M&A where you have escalating premiums before they go ahead and seriously consider selling the company. In addition, they will probably want to see what the potential market of the drug called Nuplacid, is. It's already been approved for psychosis and Parkinson's, but it's already seen off-label use for both Alzheimer's and schizophrenia, the same kind of symptoms in those diseases. It's also in trials for that. So Parkinson's alone is probably about a $1 billion indication, and you could even get up to $3 billion in peak sales. Once I think everyone has a better idea of what the actual market is going to be, I think that we'll have some serious buyout rumors and actual talks in the second half of 2018. Stock is priced for about $28. The median price target is just over $50. I personally think it goes in the $45 to $55 share range sometime in the second half of this year. Very well managed. I don't think the management is adverse to being bought out and going to work at another development company. That is our 6 stocks that I will go ahead and talk about today. I know that the first question of people viewing this will probably be, well, what about the oncology stocks? That is probably the hottest area for M&A, and I agree, and there's going to be a lot of activity in this space, but that's going to be for another video, and that's what we call a tease. So I want to thank you for listening to our outlook for 2018 as far as M&A, and I want to wish everyone a happy holiday season.